Hello, everyone. My name is RJ Robinson, and I am the CEO of RJR Prime bookkeeping and tax firm. I want to say thank you guys for coming and watching my video today. To give you a little bit of background, like I mentioned earlier, I am a bookkeeping and tax firm. I'm 100% cloud-based. I use QuickBooks or Google Sheets or Microsoft Excel to create financial statements from the general ledgers, the general journal, etc., etc. So my plan is to help people with their bookkeeping by going through this fictional company time by time and updating it with real life transactions. So let me get started. So right here, we have the title of the company, we have the title of the statement, and we have the time frame. Usually I like to spread it out because I like to use one sheet per month. So this is just BL January 2030. And the J1 will come into play later when we're creating the general ledger. It makes it all easy when you're looking up information or you're looking up transactions. So to get started, we have a partnership 50-50 split down the middle. They both invested $250,000 into the company with a combined total of $500,000. So when you're thinking about buying fixed assets, capital assets, you want to have a capital policy placed in play before buying it. So for example, we can say the capital policy will state that anything over 2,500, well, any asset over 2,500, we would like to depreciate over the lifespan of the asset. So that means anything over 2,500, we would depreciate. Anything under 2,500, we would just expense right then and there. So for the first asset we bought was a commercial building, which came out to be $100,000. So as you see over right here, off to the side, I created a depreciation for the building. So right now we will just use the straight line depreciation formula, which is price minus salvage value divided by the expected lifespan of the asset, and that will give you the annual depreciation. Small, medium-sized business, I know for my clients, I recommend that you depreciate monthly instead of annually because you get a better picture of your profit and loss per month. And I know the most important thing, especially for small businesses that are really just starting off the grass, is to have a pretty much basic knowledge of the profit and loss per month. Because with this knowledge, you can invest some of your profits, or you can go in a different route of income if you need to. It's always good to have that knowledge about your company. So after we did the formula, $100,000 minus the salvage value of $20,000. The salvage value is just the value that you think you can sell the asset at the end of this lifespan. The IRS recommends that any commercial building has a lifespan of 39 years. So you divide 80,000 divided by 39 years, and you get $2,051.28. That is your annual depreciation for the commercial building. If you wanted to do it monthly, you'll just take the $2,051.28 divided by 12 for each month, and you get a monthly depreciation of $170.94. And that'll be created adjustable journal entry at the end of each month or at the end of the year. So as you can tell, we bought a few fixed assets. So you do exactly the same thing. You would debit the fixed asset account because you're creating that asset, and you would credit the checking account because you use the checking account to purchase the asset. So after we buy some equipment, and you see how I have an equipment expense here because it was only 2 laptops for $500. So we wouldn't depreciate that. We would just go ahead and expense that right there. And then we needed to advertise our company to get us some more clients. So we put in a advertisement in a local company for $150. And that's why you would debit the advertising expense account, and you would credit the checking account. So we sent out our very first invoice to Kathy Jones for bookkeeping services. We sent her an invoice for $500, so we would number the invoice so we can know exactly where the invoice is at. We would credit the revenue account, and we would debit the accounts receivable account. The reason why we debit the accounts receivable account because we haven't physically received that income yet. With that invoice, we're sending out a contract to Kathy Jones stating that she will pay that invoice off if she wants to go further with our services. So Kathy Jones is a great client. She paid in the same day. So you would debit the checking account because that is the money, that is the account where you receive the money in. You would credit the accounts receivable account because you received that money, so you can go ahead and zero out that invoice. We sent out another invoice to another client, and the same thing what he would do or they would do that Kathy Jones did. They paid it, so we debited the checking account because that's the account where we received the money. We'll credit the accounts receivable account because we have received that money, so we are zeroing out that invoice. So we needed to buy supplies for our cleaning services. So we still keep inventory for supplies even though we're not looking to sell, just because we buy in bulk. So we need to keep record of all the inventory we buy because of the services. Same thing with equipment. Now, if you go back up and you saw that we were talking about fixed assets. Fixed assets is any asset that you are going to use in your company more than 12 months. Current asset is any asset account that you plan on converting to cash in less than 12 months. There you guys go. Thank you again for coming to watch this video. Please feel free to check out my website, rjrprime.com. Once again, I am a virtual bookkeeping and tax services, and I cannot wait to talk to you. Hopefully we can set up a great business relationship. Thank you so much, and come back for the next video. Have a RJR Prime day.